Good morning, everyone, and welcome to our last live webinar for 2019. As we all look forward to the festive season holidays and start planning for next year, I thought we should look at something that will be very important strategically for anyone who manages money. How to position your portfolio, and of course we will focus on the retail sector here, for what I think is the very likely event that Moodys will downgrade South Africa's local and foreign bonds to sub-investment grade. Please take a moment just to read through the disclaimer while I quickly go through some housekeeping issues. Firstly, please type any questions you have into the question box. I will stop at regular intervals to answer as many as I can. As always, if there are some I can't answer, I will find out the answers and put up an article in the members area. There is a slide pack available for you to download and keep. If you would like to use any of this material in your own work, you're very welcome, so long as you source it and please quote it accurately. And then, without any further mucking about, let's look at what we're going to cover today. We're going to move quite quickly through the first part of the material, as I suspect many of you are already very familiar with it. So we'll look at where South Africa is currently in terms of its credit ratings and the key reasons that we expect Moody's to downgrade after the February budget. Then we'll look at 3 different scenarios for what happens next and the likely impact on South Africa's economy. From there, we will spend significantly more time on the likely effects on the listed retailers, although obviously most of what we talk through today will apply to the unlisted space too. Right, so let's dive right into it. South Africa's 2.3 trillion worth of sovereign bonds are mostly local currency, with the rand-denominated bonds making up over 96% of the issuance. These bonds form part of the World Government Bond Index, which includes local currency, fixed-rate investment-grade sovereign bonds. To be included, a country must have an investment-grade rating from one of the 3 large global credit rating agencies, Fitch, Standard & Poor's, and Moody's. As you can see, they don't use a standard scale. For Fitch and Standard & Poor's, anything rated BBB or above is investment grade. So South Africa is already sub-investment grade as far as these 2 agencies are concerned. The country is still part of the WGBI index because it is currently on the lowest notch of investment grade rating at Moody's. If, or should I say when, Moody's downgrades us, then the sovereign bonds will fall out of the index. When that happens, it triggers 2 different events. 1, many international bond investors have mandates that they may only invest in investment-grade bonds. If South Africa's bonds are no longer investment-grade, they will become forced sellers. And 2, some bond investors will track the index, even if they don't have explicit investment-grade mandates. Again, if South Africa falls out of the WGBI, they may become forced sellers if their mandates are strict about tracking error. Foreigners currently own about 36% or 830 billion of the issued bonds. Media reports have pegged the potential outflows at between $5 billion and $8 billion, but I have seen figures as high as 15 billion potentially. So the reality is that we know that some investors will exit, but we don't know how much will flow out exactly. Some local investors are taking comfort from the fact that the credit default swap spreads have already priced in the downgrade, but I think we should be a little cautious about assuming that this means that the currency won't react. On the other hand, South Africa's bonds currently have the highest yield in the WGBI. In a world searching for interest returns, the current yields are very attractive, and so we could see sub-investment grade investors replacing at least some of the investment grade mandates that leave. It will really depend on the state of the world when Moody's downgrades. Are we in a risk-on or risk-off mode? And it is in a US election year. And what we'll need to see in Europe, particularly the US and Japan, is whether there's more quantitative easing being turned on, and so on. So what are the ratings agencies concerned about? If we were to compare South Africa to a company, they are basically concerned about whether it will continue to be able to service its debt and repay the capital amounts. In other words, is it a going concern? And here are 3 pictures that show you why they are worried. The graph on the left shows you how South Africa's debt has ballooned in the past 10 years. This is partly because the country implemented counter-cyclical measures to try and offset some of the economic impacts of the 2008 global financial crisis, including employing more people in the public sector and budgeting for investment in infrastructure. And unfortunately, state capture seems to have captured a lot of the money that was meant to be invested in productive infrastructure that would have helped support economic growth. Then the middle chart shows you that even as the national debt grew, the state-owned enterprises or SOEs also received huge increases in government guarantees for their own borrowing from the banks and other lenders. And again, state capture appears to have left us with this mountain of debt and no income-producing assets. The biggest culprit is Eskom and its capacity woes literally hurt the economy too. Then the crucial concern is shown in the right-hand chart. The February 2019 budget expected government debt to GDP to peak in 2023-24 at under 60% and then reduce. However, the October medium-term budget policy statement showed a massive deterioration because of the combination of weak GDP growth, lower tax receipts, and increased borrowings to fund spending, both in government and the SOEs. Now, Treasury expects debt to GDP to reach 71.3% in 2022-23. Why is this a problem? Because the IMF has identified a 70% debt to GDP ratio as a higher risk threshold for developing economies. At this point, debt service will crowd out other spending priorities, such as health and education or social grants. So something has to give to put South Africa on a fiscally sustainable path. And since October, the news is worse. We're not going to reach the GDP growth projections used in the medium-term budget policy statement, simply because of the load shedding we've had in November and December. And this means GDP is lower, so even without the debt growing, the ratio will look worse. And lower GDP growth puts us at risk of a recession, and of course tax collections are probably down as well, given that Q3 GDP fell 0.6%. From here, it's hard to see that the current 1.4% 2020 GDP growth forecast is anything but overly optimistic, even without the potential economic fallout from a credit rating downgrade. Then both Eskom and SAA continue to hemorrhage cash, and it's not clear that putting SAA into business rescue actually changes this in the short term anyway. And lastly, there's very little visible progress in terms of seeing spending cuts made or other reforms that would make the country's finances work. These are the reasons that our base case is that Moodys will downgrade after the budget. Then, of course, both Fitch and S&P could also downgrade us further, which will make it more difficult to get back to an investment grade rating in future. In the last 35 years, some 20 countries have been downgraded to what is euphemistically called junk status. Only 6 have managed to get their investment grade rating back, although South Africa was one of those. So I'm going to pause here for questions. Right, you've all been very quiet. Please, if you have any questions, type them into the question box and I will answer them. Right, so here's our base case, that Moodys will downgrade South Africa to sub-investment grade, presumably after the February budget. Here is a theoretical framework of what happens next, based on the experience of other countries that have been through this, including Brazil, Egypt, Ireland, Korea, and Argentina. Firstly, South Africa will no longer form part of the WIGB, and this will trigger selling by institutions with investment-grade mandates. As we said earlier, the outflows could be anything from around 75 billion rand to over 200 billion rand, depending on how quickly sub-investment grade investors see value. This capital outflow will cause bond yields to rise as the bond prices decline, and I think it only prudent to assume that the rand will depreciate too. This will feed through in subsequent months to higher inflation, and the weaker rand will impact inflation directly through things like the fuel price, the price of import parity foodstuffs, and the import of goods. And then, of course, indirectly, there will be second-round effects as well. Right, this will also cause other impacts on the economy. But the extent of these impacts will depend on how the currency responds to the event. So I've put together 3 scenarios to think about as you position your portfolios to either protect them as much as possible or find the companies to invest in that will benefit, because there will be some. We'll talk through these in more detail, but here is the framework. In the first scenario, the rand depreciates by over 20%, so to around $18 per dollar. In the second scenario, which I've called the muddle-through scenario, the rand depreciates by between 10 and 15%, so to around 17 rand a dollar. And in the final scenario, we see the currency depreciating to around 15.75 to a dollar, and then recovering back to close to 15 rand in subsequent months as high-yield investors replace those who sold. So let's look more closely at our first scenario. This is the most devastating, with significant rand depreciation that stokes inflation and means that inflation will begin to rise. More importantly, it will cause the Reserve Bank's inflation forecast to increase. If its 12-month forward forecast exceeds the 6% inflation target ceiling, then it will raise interest rates. We know that higher rates choke off economic activity, and so credit granting is unlikely to grow and may well go backwards. And companies that have not been investing a lot because of the tough economy will be even more cautious about investing, and so you get a negative feedback loop. So the economy could well enter a recession. If we are in a position to be downgraded, then government will likely have increased taxes again in February as well, including the VAT rate, seeing as this did happen 2 years ago. We saw in 2018 that this hurt consumers, and so it too will constrain economic activity. More importantly, government is likely to continue to borrow to fund spending. And so this catastrophic scenario increases the probability that South Africa might have to ask the IMF for a bailout to help it restructure its debt before the end of 2021. This is not my base case, but I think there is a reasonable probability it could happen, and so I've attached a 40% probability to it. The second muddle-through scenario is our base case, simply because South Africans are a resilient bunch. In this simulation, I've assumed that the rand depreciates by 10 to 15%, but companies continue to do as they have for the past 3 years, and they don't pass it all through because they are trying to protect volumes. This obviously spells margin pressure for manufacturers and potentially retailers too. Against this backdrop, it's unlikely that business confidence will stage a recovery, and so we can't look for new fixed investment. Instead, companies will continue to focus on cutting as much fat as they can in their cost bases. And sadly, that means that very few new employees will be added to staff, and so the unemployment rate is likely to continue to rise. But we should avoid a protracted economic slump, and so tax revenue collections should improve slightly, which means that government debt will grow at a slower pace than in our first scenario, and that means that we can kick the IMF bailout can down the road. The third scenario is the optimistic one, although I'm sadly putting a low probability of around 10% on it. Nonetheless, it is possible. In this scenario, South Africa's attractive interest rates attract investors who specialize in sub-investment grade assets and are trying to earn positive fixed income returns despite quantitative easing in the US, Europe, and Japan. So this scenario is very dependent on international economic conditions remaining favorable. I think the currency would initially weaken around 5% or so and then recover. This means that there is very little inflationary impact, and so the Reserve Bank may not raise interest rates at all. But despite this relatively benign outcome, consumer and business confidence will remain pressured unless and until we see tangible improvements in things like state capture convictions and a sense of more general optimism. Nonetheless, I think GDP growth could improve to between 1% and 2%, and this will mean that tax collections improve somewhat, and hopefully this, combined with more prudent spending, will see government debt stabilize. And then South Africa could avoid an IMF bailout entirely. Right, so what questions do we have on the scenarios? All right, I've got a question here about the rand's likely to be an adjusting mechanism. So will become weaker, which retailers will benefit more, be hit harder. I do have a slide a little bit later that will talk you through this in a lot more detail. We clearly need to look at a couple of things. The first is which are more and less exposed to South Africa. And there, of course, Woolworths with its Australian investments is less exposed than the other retailers to South Africa overall. And then we need to look at which retailers are more exposed to imports. And there the most exposed looks as though it is Massmart with the general merchandise. And then the clothing retailers in terms of what they import. Most of them are switching to more local manufacture, but even when they do that, there is obviously a component of import in terms of the fabric because we don't have any local fabric mills anymore. Okay, please let me know if that answers your question. For now, as I say, we will go into more detail a bit later. If anybody else has any other questions, please do type them into the question box. Right, so what does this mean for the retail sector? Remembering that our base case is the muddle through scenario. From a macroeconomic perspective, we think things will remain quite tough. We expect bond yields will increase, and this is typically associated with reduced PE ratings for retailers, all other things equal. The Reserve Bank is likely to raise rates, even if by a relatively small increment. And perhaps more importantly, we think the tax burden will increase once again. I imagine we'll see adjustments to the bands, another possible increase in the top marginal tax rate, and I think there is more than an even probability that VAT will increase another 1%, which all means that the environment is going to be pretty unhelpful and that consumers will remain bargain hunters. This means likely gross margin pressure, even in the food retailers, if we're going to see ongoing downtrading to lower margin commodity items such as maize meal. And for the credit retailers, the positive of higher interest rates is likely to be limited by increased bad debts, although the implementation of IFRS 15 will give them some wiggle room with the provisioning side. And then lastly, higher interest rates will affect the cost of borrowing. In addition, the lower sovereign rating will also mean the banks are all being downgraded, So their cost of borrowing in the debt market will increase, and that will feed through to those retailers that are geared. So there is a double whammy. It's not just that the prime rate will go up, but the bank's own cost of funding goes up too. So the end result is that there's unlikely to be a short-term end to the current profitability squeeze that we are seeing in most of the retailers. Okay, let's look at the individual retailers in more depth. We're going to look at all the retailers' exposure to the fallout from a credit rating downgrade in 4 key areas. First of all, their exposure to South Africa. Then look at how defensive their revenues are. Clearly, food and pharmacy are more defensive than the more cyclical retailers. How sensitive their earnings are to changes in gross margin, and how sensitive their earnings are to changes in interest rates. We've done these calculations using the most recent annual results, so financial 19 for all of them except for Massmart Holdings, which is a December year end. Here we have the percentage of revenue each of the retailers we cover earns in South Africa. Clicks Group, Dis-Chem Pharmacies, and Pepkor Holdings all don't disclose their non-SA revenue. Pepkor says it's all one geographic area, so presumably that's Africa. But even so, it looks as though its ex-SA revenues are well below 10% of the total, and that applies to Clicks and to Dis-Chem too. For the rest, Pick n Pay Stores is most exposed in revenue terms to South Africa, although its investment in Zimbabwe's TM supermarkets reduces this significantly at pre-tax level. Having said that, I'm not sure being invested in a Zimbabwean business is a better risk profile than a South African business. Adjusting for that, though, Mr Price Group is the most exposed to South Africa. At the other end of the spectrum, Woolworths Holdings Australian Adventure means it is least exposed to South Africa, although again there are swings and roundabouts, and we're not necessarily sure that Australian department stores are a better risk profile than a South African business. So this isn't a judgment about whether it is better or worse for shareholders, just an assessment of the credit downgrade risk. Our next sensitivity here is to gross margin changes. For comparison purposes, we've stress tested a 1% change in gross margin across the board. Massmart is by far the most vulnerable because it has the second lowest gross margin in the sector. Pick n Pay, Spar Group, Cashbuild, Dis-Chem, and Shoprite are also very exposed to gross margin changes. And this is simply because you are looking at gross margins that are around the mid-20% compared to the clothing retailers where gross margins tend to be well above 40%. And then here we have stress tested the exposure to a 10% increase in funding costs. This would equate to a 1% increase in the prime interest rate. And this shows the sensitivity, not our expectation that interest rates would move necessarily by that much. Retailers that are ungeared, such as Clicks and Mr Price, obviously benefit from interest rate increases, as do the credit retailers who will earn more on their debtors' books. So Lewis is particularly positively exposed here. But that, of course, doesn't offset the higher revenues from higher interest rates with the inevitable increase in bad debts and, of course, lower sales on credit as well if the economy is really, really tough. So we're going to have a quick break for some more questions. Which retailers have the lowest earnings exposure to credit sales? In other words, which retailers do not have a financing arm at all, cash sales only? So basically all the food retailers. So Pick n Pay has a credit offer that's run by RCS, so it does not fund a credit book at all. Shoprite has a very small credit business in its furniture business, but in total that accounts for about 0.5% of sales. Spar obviously is a wholesale business. It does not offer any internal credit. There is except in Build It. Then the clothing retailers all have an element of credit. The one that is the highest credit proportion is Truworths, where credit tends to fluctuate around 70% of its sales from year to year. The next highest then is TFG, although that has been reducing significantly and is now well below half of the South African businesses' sales. And of course, in the UK and Australia, there is no credit. Mr Price and Woolworths are now well below 20%, so around 18.5% for Mr Price and about 15% for Woolworths across both the food and the clothing businesses. It is higher in clothing than in food. And Pepkor, they haven't given us the number in their most recent annual result across the group, but last year it was 14% of their sales they were on credit. And then Lewis obviously is quite highly exposed to credit. In this last result, it was in the high 60%. Massmart doesn't do internal credit. Again, it has an RCS product that is provided for it externally. And then Cashbuild offers a little bit of credit in its business, but it's not material. So the ones that absolutely are exposed to credit, Truworths, Lewis, TFG, and then it's a smaller impact for Woolworths, Pepkor, and Mr. Price. Okay, any other questions? All right, let's move on. Okay, let's pull it all together then. The retail sector is extremely vulnerable to the potential macroeconomic fallout from a credit rating downgrade, and there is no way to avoid this. However, some are clearly better positioned than others. I think on the downside, Massmart has massive hurdles to overcome, given the discretionary nature of half of its product. Food and beverages accounts for around 55% of its mix, its low gross margin, and its dependence on imports for the general merchandise offer. Spark Groups looks as though it is the most defensive, despite its low gross margin of around 8% in the South African, or just under 9% in the South African business. And this is due to its international diversification, bearing in mind it's bought businesses in Ireland, in Switzerland, and is starting up in Sri Lanka. It's quite defensive food focus and low operating cost base. And Clicks Group is in second position for similar reasons, although it is highly exposed to South Africa. So the gross margin has been relatively robust. The business is very, very lean in terms of its cost base. And pharmacy, funny enough, has proved to be more defensive over the past 5 years as a category than food. And this is partly because the food retailers have seen massive downtrading, and that has actually seen a swing towards the informal sector at the expense of the formal players. So from an investment perspective, you want to be long those retailers that are most defensive and short those that are most exposed. Having said that, all the listed retailers have the advantage of scale. This means that they should take market share in a challenged environment, because ultimately tough times make companies better by making them focus on what they do well and driving cost control. So if you are investing in retailers, focus on those that are keenly focused themselves, that execute well, that look at positive returns on capital, and are unrelenting on improving costs to sales ratios. Right, are there any last questions? Okay, thank you for your attendance. I will send out the reply later today, and I wish you all the best for the rest of this year and a very happy and prosperous 2020. Thank you again. Goodbye.